I want you to just imagine a bank for a second.
Okay.
But, not the kind with the heavy glass doors or the long lines for a teller. Definitely no bowl of free lollipops sitting at the counter.
Right, right.
Picture a bank with absolutely no physical branches, like none at all. Yet this completely invisible, branchless entity boasts financial metrics that would make, honestly, the most famous traditional megabanks wildly jealous.
Yeah. I mean, we are so conditioned to associate banking with real estate, right? The
Yes.
impressive stone building on the corner.
Exactly.
But when you strip that building away and focus purely on, the flow of capital, you start to see some truly fascinating, highly efficient business models emerge. Models that just fundamentally challenge our basic assumptions of what a financial institution should even look like.
And so that is our mission for today's deep dive. We are unpacking the Q1 2026 investor presentation from Esquire Financial Holdings, Inc. That's the holding company for Esquire Bank.
Yeah.
And we really want to understand exactly how this digital-first disruptor operates in the real world. Because, look, when you look at the raw numbers in this presentation, they're generating an industry-leading net interest margin of 6.04%.
Which is huge.
Yeah. I mean, for anyone tuning in who doesn't spend their weekends reading bank balance sheets, a margin over 6% is absolutely massive.
Totally. To sort of set the stage for you here, let's look at the broader economic environment in early 2026. The average Fed funds rate was hovering around 3.75%.
Okay.
And that is basically the baseline cost of borrowing in the economy.
Yeah.
But Esquire's cost of funds, meaning the money they actually pay out on deposits to fund their daily operations, is sitting at just 1.00%.
Wow.
Yeah. That spread, that massive gulf between what they pay to acquire money and what they charge for lending it out, is the core engine driving their profitability.
I mean, getting funding for just 1% when the Fed funds rate is almost 4%, that's almost unbelievable. It's like finding a secret wholesale club where all the goods are super premium, but you're literally the only person in the entire world who has the discount card. How are they legally getting away with this?
Well, the answer really lies in their primary playground. They relentlessly target this very complex, completely underserved, and highly fragmented vertical, and that is the United States litigation market.
Okay, let's unpack this, because lending to law firms doesn't really sound like traditional commercial banking at all, you know?
Not at all.
When I think of commercial banking, I'm thinking of loans to open a new restaurant or maybe build a manufacturing factory.
Yeah, it's an entirely different beast. The total addressable market, or the TAM, for U.S. litigation is just massive. According to the source, U.S. tort actions consume about 2.1% of the U.S. gross domestic product.
Wait, really?
Yeah, that translates to an estimated $529 billion market annually.
Wow.
It's this highly specialized ecosystem. And Esquire basically provides these law firms with essential liquidity. So we're talking about working capital, case disbursement loans to cover the upfront costs of massive lawsuits, and, term loans to finance a firm's growth or let them acquire new case inventories.
And here's where we really see that net interest margins start to take shape. Because these commercial litigation loans are yielding approximately 9%.
Right.
So Esquire is getting a fantastic return on the money they're lending out. But, I mean, any bank can charge high interest.
Sure.
The real magic here, the absolute genius of the model that this presentation reveals, is the walled garden they've built. Esquire doesn't just act as a lender to these law firms. They also act as the primary deposit bank for those exact same firms.
Exactly. They hold the law firm's operating accounts, their escrow accounts, and crucially, their IOLTA accounts.
Right.
For those unfamiliar, IOLTA stands for Interest on Lawyers' Trust Accounts. So let's look at how this works mechanically for a second.
Yeah, break that down.
If a law firm wins, say, a $10 million settlement for a client, that money doesn't just get deposited into the lawyer's personal checking account.
Obviously.
It goes into a highly regulated trust account before it gets dispersed to the client and the attorneys. Now, these IOLTA accounts pay essentially zero interest to the law firm.
Oh, wow.
Meaning the bank holding those deposits gets to use that capital virtually for free.
That is insane. Imagine if your credit card company required you to keep your entire paycheck in their 0% interest checking account just to have the card.
Yeah.
That is essentially what Esquire is doing. And this actually leads to my absolute favorite statistic from the entire presentation.
Which one?
The litigation deposits to litigation loan facilities drawn is approximately 132%.
Yeah, that's a crazy number.
Meaning for every single dollar Esquire lends out to a law firm, they pull in more than $1 in low-cost or even no-cost deposits from that exact same vertical.
Yeah.
They aren't just selling seeds to the farmers. They own the silo where the farmers are required to store all their grain.
That's a perfect way to put it. And this closed-loop system is exactly what explains that 1.00% cost of funds we talked about.
Right.
They fund their 9% yielding loans using the zero or low interest deposits generated by those exact same clients. It's an incredibly elegant, self-sustaining financial ecosystem. And competitors really struggle to replicate it because it requires deep, specialized knowledge of how law firms actually manage their cash flow.
Okay, but I do have to push back here a little bit.
Sure.
Locking up cheap capital is great, obviously, but it doesn't mean much if the loans themselves blow up. The presentation says they're lending money based on, and this is a, quote, contingent case inventory.
Yes.
That basically means they're lending money based on the potential future payout of a lawsuit. I don't know about you, but that sounds terrifyingly risky.
It does.
It sounds like betting on horse races. What happens if the law firm just goes on a losing streak? Or what if they lose a massive class action suit and can't pay the bank back?
Well, this raises an important question, right? And it's actually the primary concern any institutional investor brings up when looking at this model.
Makes sense.
Lending against contingent assets sounds inherently reckless. But Esquire mitigates this through a mathematically rigorous underwriting process. They don't just, look at a flashy lawsuit and guess its potential value.
Right, they aren't just winging it.
Exactly. First, they require 3 years of business and personal tax returns from the law firm partners. Second, they secure personal guarantees for the majority of the loans.
Meaning what, exactly?
That means the lawyers themselves, personally, are financially on the hook if the firm defaults.
Okay, so they tie the lawyer's personal wealth to the loan. But how do they actually secure the firm's business assets?
They use what are called collateral assignments, or UCC-1 filings. Mechanically, a UCC-1 filing is basically a public declaration that Esquire Bank has a legal claim to the firm's assets.
Oh, I see.
So if the law firm goes bankrupt, the UCC-1 filing ensures Esquire is at the very front of the line to get paid from whatever is left. And on top of that, they run extensive personal background checks on the partners.
Okay, so that explains the legal side of protecting the money. But let's look at the math of the loans themselves. Are they lending out, like, the full estimated value of these potential lawsuits?
No, not even close. And the math of their safety net is perhaps the most fortified part of their risk management strategy. The average loan-to-collateral fee value, so the LTV, is less than 15%.
Wait, less than 15%?
Yes.
So if a firm has an incredibly conservative estimate of, say, $10 million in expected case fees coming down the pipeline, Esquire is only lending them a maximum of $1.5 million.
Yeah, they leave an enormous 85% cushion.
That is wild.
It gives the bank incredible insulation against a firm losing a case or two. Additionally, their average debt service coverage ratio, or DSCR, is greater than 4.0x.
And what does that translate to in plain English?
This metric means that the law firms, on average, are generating more than 4 times the normal cash flow necessary to make their monthly loan payments. They aren't scraping by, They are highly profitable entities before Esquire even gives them a dime.
Okay, well, that makes the model practically bulletproof. And the proof is really in the pudding when you look at their Q1 2026 asset quality metrics. Non-performing loans, which are basically loans that are in default or dangerously close to it, sit at an incredibly low 0.04%.
It's almost nothing.
Yeah, I mean, let that sink in for a moment.
Yeah.
Out of a massive portfolio of complex litigation loans, practically nothing is failing.
And even with a failure rate approaching 0, they are heavily overprepared for disaster. Their allowance for credit losses, the ACL, compared to their non-performing loans, is an astronomical 3,198%.
Wait, meaning they have almost 32 times the amount of actual cash set aside in reserves compared to the amount of bad loans they currently have on the books.
Exactly. It completely reframes what we think of as risk.
Yeah, it does.
What looks from the outside like a massive gamble, funding lawsuits, is actually a mathematically fortified fortress. They have engineered the risk completely out of the equation through sheer underwriting discipline and leaving massive collateral cushions.
Okay, but with this fortress built around the litigation vertical, you have to wonder why a bank would divert energy into an entirely different sector. Like, why not just be the law firm bank 100% of the time?
Because a stable financial institution, particularly a publicly traded one, just cannot survive on a single revenue stream. Lawsuits can take years to settle.
Ah.
The cash flow from the litigation vertical is highly profitable, but it's very lumpy and illiquid. Interest rates fluctuate, court systems slow down, you need liquid balance.
And that brings us to the National Payment Processing vertical. The presentation outlines that Esquire operates what's called an independent sales organization, or ISO model.
Yep.
And this isn't just a small side project to dabble in payments either. They are actively supporting 93,000 merchants across all 50 states.
And the sheer scale of this operation is vital to understand because it functions completely differently than a loan. This is a tech-enabled platform that performs commercial treasury clearing services.
Okay, so like the plumbing of digital payments.
Precisely. When you swipe a card at a local business, Esquire is often the plumbing behind the scenes, making sure the money actually moves from your account to the merchant's account. They handle $9.7 billion in volume, spread across 137 million individual transactions.
Unbelievable.
According to the Nielsen report, they are literally a top 10 merchant acquiring bank in the country.
The financial impact of this is just huge for their stability. This payment processing provides steady, daily, consistent fee income. It's not reliant on interest rates or a jury verdict.
Right.
Every single time one of those 137 million transactions clears, Esquire takes a microscopic sliver. And all those slivers add up to make a solid 16% of their total revenue.
It really adds up.
I initially thought about this like a sports car with a heavy anchor, right, to keep it from flipping over. But that's wrong. If the litigation side is the high-stakes, long-term venture capital play, this payment processing side is the toll booth that just collects quarters every single second. It provides the daily liquid cash flow to fund the long-term illiquid lawsuit loans.
That's absolutely right. The payment processing vertical generates incredibly stable non-interest income. But importantly, it also brings in massive amounts of low-cost merchant deposit accounts, which further fuels their ability to lend.
Oh, more deposits, of course.
Right. It completely smooths out the earnings volatility that would inevitably sink a bank relying purely on the interest income from delayed lawsuit settlements.
But look, even with billions in digital payments and zero-interest law firm deposits, a financial institution still has to play by the rules of the Federal Reserve. They still need hard, tangible assets.
Yes, they do.
So let's look at their real estate portfolio. Because even a digital-first disruptor handles traditional New York metro commercial real estate CRE, though, with an intense, almost obsessive selectivity.
They hold a $512 million real estate portfolio.
Okay.
But the underwriting here is just as rigorous as their litigation loans. They do not lend to anyone who just wants to buy a building. They focus strictly on generational owners and operators.
What does that mean, generational?
These are families and groups with deep roots, highly transparent net worth, and proven track records in the New York market over decades.
Got it. But what really stood out to me here wasn't actually what was in the portfolio, but what was aggressively missing from it.
Oh, absolutely.
Because what's missing is a glaring red flag for almost every other regional bank in the country right now. Esquire has zero exposure to office buildings. Zero.
Yep.
And absolutely no exposure to construction or land loans.
Which, when looking at the commercial real estate environment of 2026, is a brilliant strategic position.
Totally.
Office space has become notoriously toxic for lenders due to the permanent structural shifts toward remote and hybrid work. Buildings are just sitting half empty. Meanwhile, construction loans carry immense unpredictable risk with, fluctuating material costs, labor shortages, and delayed timelines.
Right. It's a mess out there.
By deliberately avoiding those sectors entirely, Esquire basically sidesteps the landmines that have severely damaged other financial institutions over the last few years.
Instead, they've stacked the deck with what actually works. 57% of their portfolio is in multifamily units, so specifically larger income-generating buildings with 25 or more units. And again, they play it incredibly safe. The average original loan-to-value on these properties is a very conservative 56%.
And if we connect this to the bigger picture, this real estate portfolio serves a very specific mechanical purpose for the bank's survival. Yes, it's a safe asset class generating steady returns. But more importantly, because these loans are so secure and well underwritten, Esquire can essentially use them as collateral to borrow money directly from the Federal Home Loan Bank of New York.
Oh.
This pledged multifamily and residential portfolio provides them with $231 million in immediate on-demand liquidity.
So if there is ever a run on the bank or, a sudden macroeconomic shock, they can just point to these incredibly safe apartment buildings, and the Federal Home Loan Bank will hand them almost $250 million in cash instantly.
Exactly.
It means their balance sheet remains highly liquid and unlevered. They aren't trapped by their own assets. Their assets provide an emergency escape hatch.
They have engineered a deeply conservative approach to risk, wrapped it in a very aggressive growth strategy, and balanced it with on-demand liquidity. It's really impressive.
It is. So we have the perfect product, the perfect risk profile, and the perfect balance sheet. But we still haven't solved the core mystery of the branchless model, customer acquisition.
Oh, yes.
Because if you have no physical branches, no local billboards, and no tellers shaking hands in the community, how do you actually find, acquire, and keep highly specialized clients like elite law firms and massive payment processing merchants?
Well, this is where their identity as a tech company that happens to be a bank really crystallizes. They have built an entirely digital-first architecture.
Okay.
At the core is a proprietary customer relationship management system, a CRM, built on the Salesforce platform. This technology gives them a single, unified view of a client from the moment they are a cold prospect, all the way through the onboarding process and into their daily banking habits.
And here's where it gets really interesting. Because they are leveraging artificial intelligence in a way you simply do not see from regional banks.
Right.
They aren't just buying generic banner ads on legal websites hoping a lawyer clicks them. They utilize what they call account-based digital marketing, or ABM.
Yeah, and the AI actively analyzes data to determine when a prospective law firm might actually need funding based on their case flow, market dynamics, or settlement delays.
So they know before the firm even asks.
Pretty much. Instead of a generic pitch, Esquire's system serves highly relevant, personalized thought leadership content directly to the decision makers at that specific firm, exactly when they're feeling the financial squeeze. They do not sell checking accounts.
Yeah.
They sell expertise.
And it clearly works. It doesn't just get them in the door, it keeps them locked into the ecosystem. The loyalty metrics in this presentation are honestly astounding.
They really are.
It notes that litigation customers who have banked with Esquire for 4 years or more have a compound annual growth rate, a CGR, of 15% on their loan balances.
And an even more impressive 30% plus compound annual growth rate on their deposit balances.
Wow.
The longer a client stays within the Esquire ecosystem, the more they rely on the bank's tech platform to run their daily operations, and the bigger they grow their business with them. It transforms a simple vendor relationship into a deeply entrenched, practically inseparable partnership.
So what does this all mean for you, the listener, trying to make sense of this changing financial landscape? When we synthesize this entire deep dive, the big takeaway is that Esquire Bank is proving the future of banking might not be the traditional model we all grew up with.
Definitely not.
It is not about offering every possible financial service to every single person on every street corner. The real path to industry-leading margins is hyper-focusing on complex niche verticals like litigation and payment processing, and using cutting-edge technology to dominate the cash flow of those specific verticals better than anyone else.
And, if we look past the litigation market for a second, this raises an incredibly provocative thought about the future of business.
Let's hear it.
If an AI-driven, closed-loop banking model can completely dominate a highly complex field like law by understanding the cash flow better than the lawyers do, what happens when this exact same model targets other high cash flow operational niches?
Oh, that's interesting. Like what?
Think about the massive creator economy or independent healthcare practices. When a specialized digital-first bank's AI knows the precise future value of a medical practice's insurance claims, or maybe a creator's back catalog royalties, the traditional neighborhood bank offering a standard checking account and a free lollipop simply won't stand a chance.